uno. How's it going?
It's going.
Yeah.
Getting easier now.
Yeah.
Well, now you know classes are starting to pick up the word.
Right.
Get things going.
Yeah. It takes a while to get the quarter going sometimes. Yes.
Ouch.
Yikes. Freaking desk.
Yeah.
Okay. Have you done any of the NNI online modules?
Mhm.
You have. Okay, so you've already registered for another course. You used one of the courses.
Yeah.
Okay. I need to give them the names of everybody who's already registered, and then they're gonna.
I think I registered, but I don't think I did it.
As long as you registered and they have your name in there.
Teacher actually last quarter gave us extra credit for
Yeah. Which class was that?
Managerial accounting.
Oh, okay.
He said it was really hard for trying to fit that into our class of what we were doing.
Yeah. Right.
So he just called it extra credit.
Uh-huh. Hi, George.
Hey.
How are you doing today?
Pretty good.
Good. Hey, Miller.
Steve?
Yes.
Next week I'll be in Cabo, so I don't know if you what we're doing next week.
You'll be in Cabo?
Yeah, my honeymoon. I'm getting married on Saturday.
Oh, congratulations.
Thank you.
Yeah, I would just check in via Canvas, and I'll be posting the video of class on the week. I guess it'll be week 5 next week in that section of Canvas. So if you want to look for the video, and then all the readings and assignments should be in there too. So
Okay.
yeah, let me know if you have any questions. So.
All right.
You ever been to Cabo before?
No, my first time out of the States. So.
Oh yeah.
Yeah.
Yeah, Cabo's interesting. It's very touristy. If you get a chance and you get to rent a car or take a bus, go up to this little town called Todos Santos. It's probably like an hour and a half north of Cabo. Really cool little beachside town. Not a whole lot going on. Not a whole lot to do there except for sit in the sun, relax, and drink beer if you drink beer. So, yeah, check it out if you get a chance to get outside of Cabo San Lucas. There's a lot going on there, but it tends to be really super touristy. And so, anyways, just my 2 cents. I've been there a few times. I wish I was going, actually. The weather is getting to be the point where I want to get someplace sunny. All right, let me take attendance here real quick. Okay, so let's see here. So my first question, well, first of all, I'll just apologize for my late notice last week. I had a kitty emergency, so not a kitty as in a cat, as in a kid. So I apologize for that. It happens occasionally. But what I wanted to start today doing is to find out how many of you guys have done an NNI module before. I already asked James about this. Any, George, I know you have. Mallory? No? So you've never had to log in to the NNI website and do any online things for like any of your other classes, TGBM classes. Okay. Let's see. Deborah, have you used any of the NNI modules before? Registered?
No, sir, I haven't. I was just like get ready to look it up to see what it was.
Okay. So, yeah, so here's what it is. Basically, the NNI modules are electronic curriculum resources that are put out by an organization called the Native Nations Institute, which is based at the University of Arizona. And these modules have all sorts of different subject matter, economic development, judicial systems, entrepreneurship. And the one we're going to work on in this class is called Nation-Owned Enterprises. So it focuses on businesses that would typically be owned by a tribal nation and not an individual. And so all of the material and everything you do is completed online. And so Deborah and Mallory, if you can do me a favor and log into Canvas and go to week 4. There's a link.
I'm on it right here, see? That's it, right?
I can't.
Oh.
Yeah, there's a link under week number 4 under the assignments that's called NNI Nation-Owned Enterprise Registration page.
Right.
So if you click on that link, it should take you to the registration page, which is specific to this class.
Okay.
And so if you haven't created, Mallory and Deborah, I don't think, if you haven't created a username in this system, could you go ahead and do that right now? I just want to make sure you get it all complete. You have to fill in everything with the stars next to it, which is, I guess, everything there. And once you do that, it should get you in to the system and bring you to the point where you can
I'm surprised I never heard about it before.
module.
Something that you think I would have heard about by now.
Oh, so wait, so first of all, if you've already registered, don't register again. Because if you,
I'm not sure.
well, if you've done anything with NNI, then you would have had to register. So if you did, any of the modules in managerial accounting or anything like that, you have. And the reason I say don't register is because they only want each student to have one username ID. So if you have already participated in NNI, then for another class, then you already have a username. And so, yeah, so I'll just have them advance. But if you haven't, in the case of Mallory and Deborah and Christopher, have you ever used any of the NNI modules in any of your other classes?
I don't even know what an NNI module is.
All right, perfect.
I'd say no.
All right.
Maybe. Unless
So
those are the
I
things
went there
that,
like you said.
the computer
Steve,
teacher was.
Can you hear me, Steve?
Yes, I can hear about 3 people talking at once, but yes, I can hear you.
Oh, okay. I'm just checking. I'm here.
Yep, okay. Yeah, so Christopher, if you could log into Canvas and go to week number 4. Under week number 4 in Canvas, there's a link that says NNI registration page or something like that. NNI, Nation-Owned Enterprises registration page. If you can click on that and fill out the registration with the username, then I can get everybody set up so that next week you can actually start using the module. The
I
assignment
just
for this,
clicked on that and it didn't work for me.
Clicked on the link.
Yeah, see, it says no content.
Because I clicked on the link and it took me right to the page, and it opened up. You might try another web browser, or you might check your internet. Well, your internet.
My internet's working just fine because I just went to the end of my site when you mentioned it to see what it was.
Make sure first registration online.
Yeah, I'm not sure why you're having problems, Deborah. Everyone else seems to be able to use the link. You might try using another browser or restarting your browser. One second. Yeah, so you're good. You can actually stop right there. So if you're registering, you should get to, once you've completed it successfully, you should get to a page that says registration confirmed. And at that point, you're good to go. And I'll be contacting the Native Nations Institute folks because we need to move everyone to the same module. The Nation-Owned Enterprises module is actually the third section of one of these course modules. And since some of you haven't completed the other two, we're just fast-tracking you to the third module. So,
Learn about this course. How did I learn about what course?
the course that the NNI course.
Oh, okay.
Oh, are you registering?
Yeah.
I thought you said you had already
I
registered.
thought I did, bro. I don't believe so.
If you think you have registered, what you might, I think there's a link.
He just gave us the information about it.
Mhm.
And she never like did it.
So, okay, I was going to say, if you want to check, you can. There's that blue link at the top that says, "Are you a returning student?" And I'll take you to another page, and there's a link that, if you've forgotten your username or password, you might just try that just to see.
Title?
Oh, you can student. Yeah.
Native Nation with the 5-year rolling.
Northwest Indian College is probably fine. And you can just put whatever mailing address you want. They, I think one of the reasons they collect or they ask for mailing addresses is because at the end of the module, if you complete it successfully, they should be mailing you this 8.5 by 11 certificate of course completion. So.
Okay, well, I went and just typed in what the assignment said, and it took me back to the same place that I was at in the beginning. So I guess I'm at the right place. It's the registered place.
Well, so let me show you where you should be. You should be.
Can you see that?
No, but this is where you should be if you look at my screen.
Okay.
This is the course registration link.
Yep, that's where I'm at right now.
And does it say NWIC Nation-Owned Enterprises Zawoski Fall at the top?
It says the exact same thing yours says.
Oh, good. Okay.
Yeah.
Yeah.
Uh-huh.
So that's where you want to register.
Okay.
Yep. Yep. So once everybody's registered who hasn't yet, then I'll be sending an email to NNI, and by next Tuesday, they should advance everyone to the correct module, and then we'll just work on that through the quarter. There are essentially 4 different sections to the module, and there's a quiz after each section that you'll take online. And so for a few weeks in a row, we'll be doing one section a week, essentially will be the assignment. And one thing I'd recommend people do is to take some notes as you're going through this, just on the most important topics of each section, because there's going to be some material from the module that you're going to need to know for the 2 tests this quarter. There'll be an essay question essentially on each of the tests about some aspect of the NNI module. So, and you can't go back to, once you've completed them, you can't go back to the slides. And so you can either take notes as you go along. What I did when I went through the first time, because I knew I was going to be teaching a course and would have to know it fairly well, is I just copied every single page, every single slide from a module and just threw it into a Word documentation or a Word document. So I had all of the info from that just sitting in a Word document after I was through. That's probably more than you need to do, but if you want to, that's a pretty easy way of getting information out of the NNI module and into a Word doc. So. Okay. So if you have any problems registering, anything like that, please let me know. And I will, either I or the NNI folks can help you get all set up with that.
So how do you know if we registered for our points?
How do I know if you register? Because
Yes.
I will be emailing NNI, and if they tell me there's no username by the name of Deborah Monahan, then I know you haven't registered.
Okay.
Yeah. All right, so tonight what we're going to do is cover material out of Chapter 3, and if we have time, I'll go over a little bit of the PowerPoint slide on Chapter 2 topics from last week that we missed because we didn't have class. It's pretty straightforward information, but I want to make sure everybody's at least has an opportunity to ask questions if they have questions about that information.
Steve,
Yep.
I have one question for you about the registration. Should I put my student email?
Yeah, I would. You can use whichever email you want, but they will, whatever email you put in there, they will be sending you course information on. So whichever one you check the most would be best, probably. All right. So any other questions before we launch into Chapter 3, financial statements?
Chapter 2 first.
No, we're going to do Chapter
2.
Chapter 2 is simple stuff. You guys got to do that yourself. Yeah. Now we'll do Chapter 3, and if we have time, we'll go back and briefly review the PowerPoints from Chapter 2. But really, Chapter 2 is what I want you to know out of there is all in that PowerPoint slide. So if you know the information from that PowerPoint slide, then you're going to be good to go. So, all right. So, Chapter 3. I'm gonna go through this, and essentially what Chapter 3 is, hopefully for most of you, is a review of financial accounting, because it covers the 4 major financial statements: balance sheet, income statement, statement of cash flows, and statement of stockholders or owner's equity. And everybody needs to be familiar with these because you're going to be using them to do calculations starting in Chapter 4 and Chapter 5, which are the next 2 weeks. So again, if you have questions as I go through this, let me know. I'm hoping that the balance sheet and the income statement are pretty straightforward and everyone understands, remembers the concepts and what's involved there. Statement of cash flows, maybe not so much, just because, at least when I taught financial accounting, I didn't cover that in depth because it's one of the more complex financial statements. Of the 4 financial statements, it's probably the main financial statements. It's probably the most complex, the most to it. So I'll spend a little bit of time going through that. The book actually has a really good overview of the statement of cash flows. So I'll show that. So I'm going to open up under week 4. There are some tables 3.1 and 3.2, and these are straight out of your book, so you can look at these in your book too if you want. Page 62 is where table 3.1 is. And I'm going to share my screen here. It's easier. Okay. All right. So we'll start with the balance sheet. And so this Allied Food Products is just a made-up company that they're using in this book, and so all of these financial numbers are made up. But they're great examples of how they're put together, and they cover the main components. So just a question about balance sheets. What is a balance sheet going to tell me? Just in general, if I'm looking at a balance sheet, what's the most important things I can take away from that?
What are your assets and what are your liabilities? And basically, how much, money do you have to work with?
Yes, yeah. So the three major classes of accounts in the balance sheet are assets, liabilities, and then owner's equity or stockholders' equity if it's a publicly traded company. And so, and it's always organized with assets first, liabilities second, and owner's equity or equity third, top to bottom. And one of the most common things that companies do with their financial statements is they'll do a year-to-year comparison. So they can see, in this case, how they were doing in 2011 compared to how they were doing in 2010. It's a way to sort of monitor change over time. And so assets and liabilities are also organized by whether they're current assets or liabilities, or whether they're we'll call non-current assets or non-current liabilities. And I'll start with current assets and current liabilities. So current assets are anything that can be reasonably easily turned into cash in less than a year. So they're the things that a company would use to pay bills in the short term. And so the current assets include things like obviously cash, because it's already cash, accounts receivable, so customer bills that you expect to collect within less than a year, and then inventories, because most companies would like to believe they sell through their inventories at least once a year. So all of those assets can be turned into cash quickly. Contrasting that is what they're, in this case, they're calling fixed assets, or they're also called non-current assets, or they're called PP&E, which is property, plant, and equipment. And those assets are the ones that are not easily turned into cash in less than a year. Those are the ones that typically have lives, if they're resources, if it's a building or a big piece of equipment, their useful life will be more than a year. And so they're considered capital assets typically. And so those are classified separately from the current assets. And in this case, they're classified as fixed assets. And all that means is they're assets, but they're just harder to turn into cash than all of these current assets up here. But you add current assets and fixed assets together, and that's what gives you the total assets for the entire company. And then they go through the liabilities section, and just like in assets, they organize things from current, and in this case, they're calling the non-current liabilities long-term bonds. And I'll talk about that in a second. But current liabilities are sort of the opposite of current assets. They're bills, things that the company owes that they will need to pay back in less than a year. And so accounts payable represents, all their monthly, quarterly bills, utilities, property taxes, things like that, all are classified in accounts payable. Actually, property taxes are probably classified as taxes payable. Accruals are things, you can have accrued wages, which are wages that, for instance, if somebody here at the college begins work and they work for a full week, but they don't get paid until a week after that, all the work for this current week is considered accrued wages because the company still owes them to the employee even if it hasn't actually paid them yet. So it's an accrued liability. It's something the company still owes even though they haven't paid. And that accruals are typically either wages or taxes. A lot of times the company will collect sales tax, for instance, and that's not a revenue. The sales tax just gets, at least in Washington State, gets passed straight on to the state of Washington, and so that's an accrued liability. The company still needs to pay that. And then the last current liability listed here is notes payable, and that's really just a short-term loan. So it's a loan of less duration, less than 1 year. So all of these current liabilities have to be things that are owed in less than a year. And then the only long-term liability that they list, or non-current liability, is this long-term bond here. And all that is it's a loan. A bond is essentially a loan, an investment that people will loan the company money. That's what a bond is. Essentially, it's a promissory note to an investor saying, you gave me $1,000 in return for that. I promise to pay you, let's say, 3% interest a year for 10 years, and at the end of 10 years, I'll give you back your $1,000. That's a longer-term bond. And so those are all classified separately from the current liabilities. And again, this really allows you to, well, we'll be doing calculations next week involving current and long-term liabilities and current and long-term assets. But it gives you an opportunity to really look maybe in more detail at what a company owes and when they owe it, and what a company has in available liquid assets and what it has in, say, fixed assets or long-term assets. And then all the way at the bottom is, and so just like, I should say, just with the assets, the debt or the total liabilities, debt and liabilities you can read is the same thing. Here it's labeled debt. Total debt equals current liabilities plus the long-term bonds. And so that's where they get this, and since this is in millions of dollars, this is actually 1 billion. A little over $1 billion in total debt, a little over $2 billion in assets. And the difference essentially is what the owners of the company have. If they were to sell everything, and this is just a theoretical example, but if they were to sell all the assets that they had and they were to pay off all of their liabilities, both long-term and short-term, then they technically would have $940 billion left as the equity, as the ownership equity of the company, or for the owners. And so that's what's listed here as 940. And in publicly traded companies, so this common equity comes from two different sources. It comes from the common stock value, and it also comes from retained earnings. And those two added together equal the total common equity. And retained earnings, anybody know what retained earnings are? Where do they come from? Anybody want to guess?
Well, that's money that's not spent during the year, that's carried forward to be used in operations into the next year.
Right. And specifically, it's profits or income from the current year that are not distributed out to shareholders in the form of dividends. And so if the company makes, let's say this year the company made $100 million in profit, in income, and they decided to give $50 million to their shareholders in the form of dividends. Dividends are a way that investors can make money. So the $50 million that's remaining that they didn't distribute out to their shareholders, that goes into retained earnings. That's added to retained earnings. And companies use those funds to improve, buy new capital assets, to do major renovations on capital assets, and really to provide sometimes some needed cash flow for the organization, is to retain some of those earnings in the corporation itself. So, okay, so this is sort of the balance. It's my explanation of the balance sheet here. Anybody have any questions about any of what I just covered there?
So is what you're showing us different than what we have in the book?
Not if you're using the same edition of the book that I have.
Which is the 7th edition, right?
I can't remember which number it is here. Should be the 2010 edition, I want to say.
So it's got 3.
Or 2011, January 2011. Yeah, chapter 3 on page 62. Yeah, I believe this is what you should be showing if you're using the same edition.
Okay, there's 231s. That's why I was lost. I have it now.
Oh, okay. Yeah, I think in this book they have tables and they also have figures. And sometimes, so they'll have both a table 3-1 and a figure 3-1. Okay. So that's the balance sheet. The next financial statement that's pretty crucial in a lot of what we're going to be doing is the income statement. And so that's table 3.2 on page 67. And again, it's sort of in the same format as the balance sheet insofar as it's comparing 2 years, 2011 and 2010 together. And this is a really simplified income statement here. This is not what we call a classified income statement where it has all the different types of revenues or the cost of goods sold and all the different types of expenses broken down. This is a very high level income statement here. But like all income statements, it starts with sales. That's what everything comes out of for a business is your sales. And so that's again, this is done in millions of dollars. So talking $3 billion in sales in 2011. They take away operating costs, depreciation, and amortization. And so this lumps all, or excuse me, except depreciation and amortization. So this lumps all of their expenses into this one line item except for depreciation and amortization. I'll talk about that in a second. So again, this is a really simplified income statement. And then they also include depreciation and amortization separately, which is 100 million here. Can somebody give me a brief definition of depreciation, what it is and why we care about it? George? I'm just going to call on people.
Wear and tear assets.
Where and
Reducing value.
okay, so Mallory says wear and tear on assets and a reduce in value. So yeah, that's a pretty good explanation. It's sort of depreciation is the estimate of loss of use of an asset that's expected to last a long time. And so if you buy a car, let's say, if a business buys a car that costs $20,000, do they get to take $20,000 in expenses that year when they buy it? Do they say, okay, we spent 20 grand on a car, so we're going to take 20 grand in automobile expenses this year? Does that sound?
I was wondering why you couldn't hear me. I had my mute on.
Oh yeah.
But there's basically 2 aspects to look at the same concept, right? For an accountability, as far as an accountability and depreciation goes.
I'm not sure what you mean by accountability.
Well, I mean, because there is either the decrease in value or the increase in value, right?
Right.
The fair value depreciation too, right?
Well, so depreciation is the loss of use, or and appreciation would be the increase in value of an asset. But here we're just talking about the estimated loss of use for assets. That's depreciation, and it's an accounting method to estimate the loss of use. So, for instance, a vehicle if you bought it for $20,000 the first year, you don't get to take $20,000 in expenses because that vehicle should be used for longer than a year, right? So most companies will have what they call a depreciation schedule, and it'll list all of the capital assets the company has, things like computers or office equipment, vehicles, buildings, infrastructure, roads and utilities and things like that. And they give each of those assets a useful life. So in the case of the college, all cars, we make the assumption that the car is going to have a 7-year useful life. And so if that car cost us $20,000, actually, let's make it really easy. Let's say it cost $21,000 when we bought it, and that car has a 7-year useful life. Then you divide 7 into the total cost of that car, and you get $3,000 back. That's what you would take as expenses each year as depreciation on that particular unit. And so you can't recognize all the expense and capital assets the first year. You have to sort of take those expenses as you slowly use up the asset. And that's what the real goal of depreciation is. It's trying to financially show what's happening to an asset as it's used up.
I think I understand what you're saying now. So like, okay, so like for example, if like a depreciation expense of, let's say, like 100 per year for 5 years, may be recognized for an asset costing 500, right? Is that what you mean?
If it has a useful life of 5 years and it costs $500, then it would be $100 every year, right? Yep. And that's called straight line depreciation. There's a number of different ways you can do depreciation. In nonprofit organizations, it doesn't matter as much because we're tax exempt, or at least exempt from income taxes for most purposes.
Right.
And so the way that a nonprofit depreciates is usually just straight line. They'll depreciate the same amount year after year. For-profit businesses, on the other hand, will use other methods to depreciate assets. You might recall something called DDB, or double declining balance. And that's just a way to accelerate the write-off. You take more expense in the initial years and less in the years further out. So,
and that varies with the country, right?
Well, it varies with the country as far as which forms of depreciation you can use. As some countries, I would imagine, don't allow double DDB depreciation. They might require you to do straight line depreciation. But I'm not well versed on tax law and all.
Yeah.
So
Neither is Donald Trump.
So that's what depreciation is. It's really just the financial estimate of a loss of use of an asset. And so that comes off just like an expense, like these other operating costs. And so it leaves you with this total operating cost of $27.16, which is just your depreciation plus your operating costs. And then you subtract that from your total sales, and that gives you this operating income, or EBIT. And so it will be important for you to know the difference between EBIT and EBT and EBITDA, EBITDA. And we'll go over those. But EBIT just stands for earnings before interest and taxes. So before you take out your expenses for interest that you paid on loans or taxes that you have to pay the government, this is what you had. So in this case, in 2011, they had $283 million in operating income, EBIT. So then you recognize the interest expense, which in this case is $88 million. You take that out of EBIT, and that leaves you with $195.8 million in earnings before taxes. So that's EBT. So that's different than EBIT. Earnings before taxes does have interest expense included in it, unlike the EBIT.
So there's a different way for figuring it out depending on the method. Different math solution for each method.
Yeah, maybe, but I mean, this is pretty much the calculation here. I mean, as far as the order in which you take things.
Yeah, that's kind of like the straight line method.
Yeah, a little bit. So we have earnings before taxes, and then the last thing that comes out here in this particular example is taxes, which are listed here at 40%. You will never see a corporation pay 40% in taxes. I guarantee that. But in this case, they did because they're great citizens. And so their net income at the end of the year is 117.5. And so that's the actual take home for the owners of the business. So in this case, it's a publicly traded company, so they're shareholders. So there's 117.5 million that can be distributed to shareholders. But this is what's good to look at, and I think this really helps understand how dividends and retained earnings operate. The company could pay out $117.5 million of dividends to all of their shareholders if they wanted to. Most companies don't do that because they want to keep some assets, hold some assets back so that they can, repair capital assets or acquire new capital assets, grow the company. And so in this case, what they decided to do in 2011 is of that 117.5, they distributed 57.5 million as dividends to all of their shareholders. And so if we look down here, dividends per share, they distributed $1.15 per share of those dividends. Because I believe there were 50 million shares outstanding. So if you take 57.5 million and divide it by 50 million, you should come up with $1.15 dividends per share. So everybody, each shareholder, for every share they receive, they would receive a check for $1.15.
Now, let's say we wanted to find out for the first, second, and third year, then we just take the annual depreciation expense, right, would equal the cost of fixed asset, right? The residual value, right? And that would be over the estimated total production times the actual production. Is that correct?
I'm losing you somewhere in there.
I'm thinking if we wanted to find out for more than just this year, like if we wanted to find out for the years 1 through 5, then we would do the math a little different, right?
Are you talking about depreciation or
information, right?
Are you depreciation or dividends?
I'm talking about the depreciation expense and the depreciation rate and the depreciation base, but for 5 years. We would find that out with the same.
Yeah, I mean, if you have, well, what you need to calculate depreciation expense is the total cost of whatever the asset was when it was purchased, and then what the useful life in years is. And so you would simply, if it's an asset that has a 10-year useful life and it costs $1,000, then you would depreciate it over 10 years at $100 a year. So it just depends on the asset and depends on, the organization. Some organizations will say have a useful life of a computer of 3 years. Others will have a useful life for 5 years. And so each organization might be slightly different as far as how quickly they depreciate their assets.
I was just thinking it'd be nice to have it on record, for yourself, for the company.
Well, it will be. It just won't be, the specifics won't be displayed in the income statement.
Right.
No.
But there, you could tell what your book value at the end of the year would be off of this too, right?
You could, well, no, not necessarily, because you would need to have the accumulated depreciation, and that is up here in the, well, it's not included in this particular statement, but it would be included in the balance sheet.
All right.
Yeah.
It's confusing. There's so many rules to accounting.
Yep. So back to the dividends here. So they distributed this 57.5 million to their shareholders, and that means of the 117.5, there's 60 million left. They're keeping those. They're adding that to their retained earnings. So they're keeping $60 million to do whatever they're going to do with there. And so I believe, let's see, was that here? Yeah, you can see here on the balance sheet that the retained earnings increased from 2010 to 2011 from 750 million to 810. And so that's where this $60 million comes in. That's what increased the retained earnings. So basically, retained earnings are earnings that the company has had that they don't distribute back to their shareholders right away. They keep for the operations of the business. Down here is a little bit of calculations of per share data. You can calculate, and this is important. These are important metrics for investors, but they are interested in seeing what the earnings per share are, and then certainly what the dividends per share are. Dividends are one of the prime sources in certain stocks of making money for investors, aside from the stock price actually going up. And then you can do a calculation of book value per share too. We're not going to be focusing too much on the stock calculations. We're going to be working more with just calculations straight off the financial statements to look at performance. All right, so that's the income statement. Anybody have any questions about any of that information there on the income statement?
So these are all in Excel, right?
Well, this is just a PDF file out of the book.
Right, but if the book, well, if your book's brand new, it comes with a student access thing, and it helps you with the files. Takes you right to Excel.
Yeah, I don't use any of the additional resources just because the version of this text is 4 years old now, or 5 years old now, I guess, and they don't support it anymore. So, and I don't require the most recent text because I don't want you guys paying $200 for a textbook for 3 months. So,
Will we be tested on an income statement or a balance sheet or any of those equations?
you will be. So the question was, will you test it on an income statement or balance sheet? On the tests, both the first test and the second test, there will be financial statements, an income statement, and a balance sheet for sure that you will have to calculate performance measures from. So, like the current ratio, which is the ratio of your current assets to your current liabilities. So you would need to know how to calculate that. It's basically current assets divided by current liabilities. And so, yeah, you'll need to be able to both find that information in the financial statements and then do the calculations.
You're not going to test us on nothing that you're not going to teach us, right?
Correct. No. Yep. Everything will be from class or from resources on Canvas. So, yeah. Let's see here.
So what do you think about financial accounting? It gives me a headache.
Well, I do it as a full-time job, so I sort of enjoy it sometimes. All right, so that's the balance sheet and the income statement, and then there's statement of cash flows and stockholders' equity. Let's take a break right now because the statement of cash flows is a little bit to explain.
Yeah.
So let's take our 10-minute break right now, and then we'll come back and look at the statement of cash flows and the statement of stockholders' equity. All right. move on to the statement of cash flows. So what does the statement of cash flows show me? Tell me when I see that.
Can you hear me this time?
Yep.
Okay, so according to our book and these charts, what you're basically there's the introduction that I'm seeing in here. It's changes in cashes, the transactions, and like for the different parts of the month, the depreciation, the disposal of assets. Basically, it's one of the it's basically, so from what I see in our textbook, it's operating activities and vesting activities, financing activities, and supplement information.
Right. So what is that? What does that 10 at the bottom of that whole list of things tell me? It says 10 there.
What does it tell you?
Yeah.
It tells you it. What do you mean?
I mean, what does a 10 represent at the bottom there? Right down here. So the 10 represents how much cash or cash equivalents the company has at the end of the year. So this is just for 1 year, 2011. And it tells you that the company at the end of this year, I'm going to say only, has $10 million. And the reason I say only is because if you look immediately above that, it says on S here, cash and equivalents at the beginning of the year was at 80 million. And so from the beginning to the end of the year, this company has gone from having 80 million in cash to 10 million in cash, which is typically not a good sign, unless they had a bunch of extra cash they didn't need in the first place, which usually isn't the case. So really what a cash flow statement does, it gives you two very important pieces of information. It tells you, based on your operations over a period of time, usually a year, your cash flow or the amount of cash you had was impacted in this way. And so from 2011 here on I'm going sort of from the bottom up here because it might be easier to understand this way. You can see under R here, it says net decrease in cash. So this negative 70, whenever you see anything with brackets, by the way, in this class, in accounting in general, that means that's a negative number.
That's a big red flag, right?
Yeah, that's a negative 70 million. So basically, over the course of 2011, they reduced their cash by $70 million, which is where this 10 comes from. They started with 80. Over the course of the year, they decreased their cash by 70, which leaves them with 10. Okay. So, and cash flow statements are important because if you use accrual accounting and do things like depreciate assets, then your net income doesn't always equal what your cash inflow equals for the year, right? Because you're not taking into account things that you either financed or you're depreciating over a number of years. And so that's what these other sections in the statement of cash flows do. They sort of summarize the activities that have an impact on the cash flow of the business, and then they all come together down here in the summary section 4. And so
basically what you're saying is because the income statement is prepared under the accrual basis of accounting, that the revenues reported may not have been collected, right? And so that's what this is why we would look at it this way, because this way we would be able to review the balance sheet and the changes to determine these facts, right?
That's one of the reasons why your revenues wouldn't equal your actual cash flow. You know, you can also finance assets, so you might buy a $20,000 vehicle, but if you financed it, then you didn't pay $20,000. Obviously, you paid some portion of that, and so that would cause a difference. You know, whatever the difference between your depreciation expense on that vehicle and the actual cash outflow that you had would be the difference too. So, yeah, there are a number of reasons in accrual accounting why that would create a difference. And so I'm going to go over each of these real briefly. But one of the things I'd really encourage you to do, and I really think this is a helpful table, because it includes, if you look beneath the table on this page and then on the next page, which would be page 70, it gives you an explanation of each of these line items here: operating activities, net income, depreciation and amortization, and it will explain what's going on in each of those. And so because this statement is probably the most difficult financial statement that you're going to be dealing with in this course, I'd recommend that literally in the next 24 hours that you go back through this statement of cash flows and just review what's going on in each of those. And it should hopefully help cement some of this information for the long term. So, but I'm going to go over this real briefly right now, each of these, and fire questions as I go along. I'll start at the top now and so this is organized into these different activities which have an impact on cash flow. And it starts with operating activities, and it goes to investing activities, and then finally financing activities. And they all can have an impact on a company's cash flow. So under operating activities, the first item is net income. And this, all of these figures trace back to the examples that we just went over for the balance sheet and the income statement. So if you're interested in, tracing back where some of these numbers came from, you can look in those two financial statements and find some of that data if you're interested. But this $117.5 million, that came directly from the income statement. That was the net income for the year. And so that's everything else being equal. If they collected all their sales and they didn't depreciate anything, then their income would be 117.5 and their increase in cash flow would be 117.5. So this adds, again, positive numbers will add, brackets will take away. So it adds 117 to the cash flow. Depreciation and amortization is 100 million. So that's what they're taking as an expense this year for depreciation. And that's a positive 100. Do you have any idea why that would be positive, that depreciation expense?
Does somebody else want to go, or?
Yeah.
Might be the only one talking.
Yeah. Well, it's because you get to claim that on your taxes, and it actually adds to your money.
Sort of. Yeah, you definitely get to claim it on your taxes, or it's included in your year-end financials, right? $100 million of depreciation expense. So that would be expense that you recognize for the using up of these assets. But that doesn't mean you paid cash for that, right? If it's depreciation expense, it has nothing to do with a cash outlay. And so you're recognizing an expense, but you're not actually paying cash, and therefore it actually increases your cash flow by 100 million because you're showing it as an expense in your income statement, but you're not actually forking out any cash for that depreciation expense. So as
the reason why it's positive is because the cash flow statement identifies the cash that is flowing in and out of the company, and if the company is consistently generating more cash than it's using, then the company will be able to increase its dividend, right? And so it can buy back some of its stock, reduce debt, right?
Right. In this case, again, depreciation and dividends are two separate things. In this case, depreciation expense is just a positive because we're recognizing an expense on the income statement, but it's not actually a cash expense to us during the year.
So it's different than being perceived as good stockholder value?
Yeah, I mean, this is just, depreciation was one of the expenses that impacts cash flow, but yeah.
Okay.
So I don't know if you're getting depreciation and dividends mixed up, but
Probably.
Yeah.
I have the whole thing in financial accounting is mixed up for me.
Oh. Yeah, it's going to be a good thing to review these financial statements because we'll be using them throughout the quarter. So definitely want to be comfortable with them. Okay, so that's depreciation. Increase in inventories. And so we show an increase in inventories here. That means they actually increased the amount of inventories from 2010 to 2011. And it's showing a negative $200 million impact on cash flows.
Right.
And so what's going on here is that they increased their inventories by $200 million. And thus they have an additional inventory of an asset of $200 million. But assuming they paid cash for it, they have $200 million less in cash based on that increase in inventory. So that's why there's a $200 million decrease in cash flow based on inventories. If they decrease their inventories in 2011 from 2012, then that would actually increase cash flow. So the opposite would be the case. And you can do the opposite for anything here that says increase. If you change that around and say decrease, then it's going to do the opposite over here. So if we go down to accounts receivable, they had an increase in accounts receivable of $60 million. That means they had $60 million of sales where they offered customers credit. And so they haven't received payment yet, but they made the sale. And so because their accounts receivable went up and they haven't actually received that money yet, that has a negative impact on their cash flow of $60 million.
Okay, now I get it.
So accounts payable, we have an increase in accounts payable, and that would cause an increase in cash flow by $30 million. Any idea why an increase in accounts payable would actually increase cash flow? Mallory.
An increase in accounts payable. Because maybe it's not paid yet.
Correct, because it's not paid. That's why it increases the cash flow. So if your accounts payable, which is what the company owes to other vendors, if it goes up during the year, that means they've acquired things from vendors, but they haven't paid for them. And in fact, they haven't paid for an additional $30 million worth of equipment. And so because they put it on credit, they bought it, they didn't have to pay cash for it. So that's a positive impact on their cash flow. So yeah. When they pay that off, then obviously they'll have a negative impact at that point. But because we're just going year to year, these comparisons, by the way, are all, when it says increase, that just means increase compared to 2010.
Okay.
Let's see. G, we have an increase in accrued wages and taxes, and that has a positive impact of $10 million. It's pretty similar to an increase in accounts payable, because what that means is that there are wages and taxes that the company owes, but they have yet to pay those. And that's $10 million. They have $10 million more of those accrued wages and taxes in 2011 than they did in 2010. So that increases their cash flow by $10 million for that activity.
I think of you.
And then right here in H, this just totals up everything above it. So based on all of these operating activities here, the impact on cash flow is actually negative $2.5 million. So that's just from operating activities. We go down to the second section here, which is long-term investing activities. And this pretty much revolves around acquiring capital assets, property, plant, and equipment, things that have a very long useful life. And it shows here that they added $230 million of property, plant, and equipment in 2011. And based on that, they have this negative $230 million in investing activities because they had to pay for that somehow. And so they had to pay for it in some form with cash or with a loan or financing or something like that. So that activity in and of itself causes a negative $230 million cash flow based on these investing activities. And then this third area here, the financing activities. So this has to do with what the company has done to raise money, either through issuing short-term notes payable, which are due in less than a year, or with issuing bonds, which are essentially loans that are due in longer than a year. So a 5-year bond or a 10-year bond essentially is a promissory note to pay back that sum of money in that period of time. So here in M, we have increase in notes payable. So they increased the amount of short-term debt that they have, notes payable, by $50 million. And by doing this, that increased their cash flow by $50 million, right? Because they got $50 million in exchange for issuing these notes payable to the investors, who then get paid out over time, or over the next year, I should say. And then right below that is the bonds outstanding. So the increase in bonds outstanding, there's $170 million more in bonds outstanding this year than there were in 2011. And so just like notes payable, that's a positive impact on cash flow. So that's $170 million positive cash flow. And I'm guessing that some combination of these two, notes payable and bonds payable, went into providing the financing for this property, plant, and equipment that was purchased. Because that was purchased for $230, and if you add these two together, you get $220. So I'm guessing that would likely be where those funds went.
Okay, so basically, what you're saying is you just got to do the math, right? Like for the current liabilities, it'd be accounts payable plus the accruals plus the notes payable, right?
From the balance sheet?
Yeah, to find out the current liabilities, you would add the accounts payable, the accruals, and the notes payable, right?
Right, yes, correct. Yeah, and in this case, all we're looking at is notes payable, the increase in notes payable, and the increase in bonds outstanding from year to year. And actually, if we go back here, oh, whoops, I closed it. Just 1 second, I want to open up. If you look back at the balance sheet, let me open this real quick here. You look back at the balance sheet that we went over, which is 3.1. You should see long-term bonds went from $580 million in 2010 to $750 million in 2011. So that's where that $170 million increase in bonds came from. And the $50 million in increase in notes payable, you can see it was $60 million in 2010 and increased to $110 million in 2011. So you can see those.
Right, but the capital expenditures are equal to the change in the net plant equipment plus the annual depreciation expense.
Is that right out of the book? I'm not really sure what
Yeah,
you're.
it's on the thing on what we're looking at right now.
Say that one more time.
That the capital expenditures are equal to the change in the net plant, right? And the equipment and plus the annual depreciation expense, right? So basically the
The capital expenditures in 1 year or the total capital expenditures?
total.
I don't think that would be right.
I'm guessing in my head, but you have to do the math to figure it out. But
Yeah.
this looks like from the numbers that are listed that it'd be like that.
So yeah, you can look back at these different financial statements and see where some of these numbers come from. Down to O here under financing activities, payment of dividends to stockholders. We saw this on on the income statement, where they paid out $57.5 million to stockholders in the form of dividends. And that's a negative because they're paying out cash. And so the sum of those three financing activities is positive $162.5 million. And so after you've gone through all of these three top sections, then you add the totals up. So you would add negative 2.5 with negative 230 with a positive 162.5. And you should come up with this negative $70 million in cash flow over the year. And so that's the total impact on cash flow from all three of these groups of activities here. And again, this would this cash flow statement would be somewhat of a concern unless there was a real good explanation for why their cash decreased so significantly in the course of 1 year, from 80 million to 10 million. That's pretty drastic. All right, so this is the statement of cash flows. And again, all of these notes that begin on this page and go to the next page are really good in explaining what's going on in each of these rows. So highly recommend you reviewing those. All right, any questions on the statement of cash flows?
Why did whoever invented this have to make it so difficult?
Well, it's basically it's occurred over hundreds of years, and it's what's sort of necessary for companies, especially public for-profit companies, to provide meaningful financial statements to investors and regulatory agencies and taxing agencies and things of that nature. So that's what they need. All right. So the last financial statement here, and we're not going to really use this too much in our calculations, but just so you're aware, in financial accounting, you probably dealt with a statement of owner's equity, which is a statement of equity for a private company. And so when you have a publicly traded or a company with publicly traded stock, then they have a slightly different form of owner's equity statement, and it's just called the statement of stockholders' equity. And it lists the number of shares outstanding at the beginning of the year, at the end of the year. So there's 50 million at the beginning and the end. They didn't issue any new shares of stock. The amount, this is the amount that this shares of stock originally sold for. So these 50 million shares sold for $130 million. And then you take these retained earnings, which we looked at in the income statement, and they started the year with $750 million in retained earnings. So if we go back to here, yeah, you should see on the balance sheet, 2010, 750 million in retained earnings. 2011, 810 million. And that 810 million was determined or was calculated by adding the income that was earned during the year, which is the 117.5, subtracting out what was distributed to shareholders in the form of dividends, which was 57.5 million. And if you add these three together, you get 810 million, which is the new balance of retained earnings at the end of 2011. And we have total stockholders' equity here is the last column. It starts the year at 880. And because we kept $60 million of retained earnings for the company, then that means that the stockholders' equity also goes up by 60 million. So it increases from 880 million to 940 million at the end of 2011. So this is a statement of stockholders' equity. Any questions about this? It's pretty, hopefully, simple and straightforward.
Good to go. that part anyways. I mean,
Go with that part.
well, the others, please.
Yeah.
I could read through them.
I highly recommend, like I said, reviewing definitely the statement of cash flows, because I'm assuming that you didn't spend much time in financial accounting dealing with that. So, yeah. All right. No other questions about statement of stockholders' equity?
That one was more familiar.
All right, a couple more things out of chapter 3 I want to cover, and are about income taxes. Income and capital gains taxes. And so, and most of this I want you to understand on a conceptual level. So I'm not going to ask you to be calculating people's taxes based on a tax table. But it is important, I believe, for you to understand how a progressive tax system like we have here in the United States works, progressive income tax system. So I'm going to go through this real briefly. On page 79 in your text is table 3.5 here. And this just gives you the breakdown of the tax brackets, at least as of April 2010. And these are the federal income tax brackets that are used to calculate the income taxes that each of us pays as individuals. And a progressive tax system essentially taxes the people who earn the least, the smallest percentage tax, and the people who earn the most, the highest percentage tax. And it's called progressive because we're taxing those who earn more, a percentage more than we're taxing those who earn less. And so here, and there's several different brackets. This one, or several different types of brackets. This shows two, one for single individuals and one for married couples filing joint returns. There's also head of household, and there may be one other bracket, but these are the two most commonly used. And what this shows you is that, we'll just use the single individual table as an example. What this says is that if you earn anything less than $8,350, you should be paying 0% taxes.
So Donald Trump should be paying a lot of money in taxes.
Yeah, except he had a $916 million loss about 13 years ago that he's still carrying over to whatever income he makes. So yes, so you should be paying 0 taxes here if you earn $83.50 or less.
Mm-hmm.
If you earn $83.50 to $33,950, they're going to tax you on the money here, $83.50 to $30 at 15%. So everything that you earn after, I'm sorry. Let me restate this first row here. It's not that you are not liable for any taxes at $83.50. In fact, you have to pay 10% of everything you earn over $0. And we're not talking about, we're not considering exemptions or any write-offs or anything like that. This is just the basics of tax. We're not going to get into any of the other complexities of tax loopholes or anything like that, because there's plenty of those. So up to $83.50, you'll pay 10% of what you make in income taxes. $83.50 to $33,950, you're going to be paying 15%. But you don't pay 15% on that, and let's say you make $30,000. You don't pay 15% on the entire $30,000. You only pay 15% on the amount that's above $8,350 to $30,000, right? Because this is the second tax bracket. This is where it kicks in at 15%. So you'll still pay 10% on the first $8,350 that you've earned, but then every dollar after $83.50 until you hit $33,950, you're going to be paying 15% as your income tax.
I'm sorry, I'm just trying to follow along. I got a totally different table than you.
Oh, really?
I'm not totally different. I got April 2011. The
Oh,
numbers are just different.
yeah. You have an more update text apparently. So this is what's progressive about it, is that you're going to be paying these different rates of, these are the rates of income tax that you'll be paying in each of these brackets. So it goes from 10, 15, 25, 28, 33, and 35 is the top tax bracket right now. Back in the 70s, in the early 70s, the top tax rate was over 70%. So tax rates have declined tremendously in the past 20 to 30 years.
Did it, it change frequently? Or?
They don't change that frequently. Right now, there's so many loopholes in the tax code that no one really wants to address it. And so just sort of kick the can forward to the next legislature. So again, what we're looking at here in the brackets is you'll pay 10% or 10 cents on every dollar up to $83.50. You'll pay 15% or 15 cents on every dollar that you make between $83.50 and $33.950. And above that, if you're in the third tax bracket, then you begin paying 25% or 25 cents on the dollar for everything above $33,950. And so that's why, even though that these are the tax rates for each of the brackets, you'll actually end up paying something slightly different if you look at the average tax rate at the top of the bracket, because you're not paying, for instance, if you're in the third bracket here, even if you make $82,250, you're only going to have a real tax rate of 20.4%, because only a portion of it you were charged 25% tax. You were also charged 15% on the portion from $83.50 to $33,950, and only 10% on the portion that you earned up to $83.50. Does that completely confuse anyone? Sometimes I have a difficult time explaining progressive tax rates. So if it
The
does,
math isn't confusing, but the whole fucking tax law is confusing.
oh yeah. Yeah, that's why I'm not addressing the tax law. Everybody's good.
Sorry, I didn't mean to say the F word.
Oh, that's all right. I will recover. So really the big takeaway here is from progressive tax rates is, one, the percentage increases the more you make, and two, for each of these brackets, you're only paying this increased amount within that bracket. For all the ones that are below you, if you're making $50,000, you're paying 15% on this amount and 10% on this amount. So yeah.
If Trump makes it for president, it will collapse the current 7 tax bracket thing, right? The 3 brackets, right? But the poor people won't really have to worry about it, right?
Oh, I don't know what Trump is proposing. I'm not paying any attention to what he says.
Oh.
Yeah. No, he can't do anything about the tax code. It's all up to the legislatures. So the senators and the Congress people are the ones who essentially make tax law. So, yeah.
Well, that's his plan, I guess.
Yeah. All right. So this is for income taxes here. So this is what you pay on money that you make for working a job, right?
Okay.
There are other types of taxes. And here's corporate. This is the corporate tax structure as of January 2010. And you see it's a progressive tax structure also. It's set up slightly differently. Although it's not completely progressive, because if you look, for whatever reason, don't ask me why, the $75,000 to $100,000 tax bracket is 34%, whereas the $100,000 to $335 is 39%, whereas the one above it is only 34%. So again, this is a great example of how our tax law is screwy, especially for corporations. If you haven't heard about Apple parking billions of dollars in Ireland, right now, because if they bring it back to the United States, they'll have to pay taxes on it. You should check that out. There are many multinational corporations that take advantage of tax laws in different countries. So they'll incorporate in maybe the Bahamas, or in this case, they'll incorporate in Ireland for whatever reason.
That's not tax fraud?
Ireland has no, it's not. They're following the laws. They're just choosing to do business in an area where they get charged less taxes. And so, you know, if Apple can choose to operate a sales office out of Ireland, they route all of their revenue through that Ireland sales office. They don't have to pay the income taxes they would have to pay if they brought that money back in the United States. And so right now, I think Apple's sitting on, I want to say $65 billion of cash in Ireland, some crazy amount like that, because they don't want to bring it back because they're going to have to pay 34% tax on it or whatever. So
That's crazy.
it's okay. So those are corporate taxes. There are two other types of taxes that they talk about in Chapter 3. One is a capital gains tax. And a capital gains tax is a tax that's levied when you make money on the sale of an asset. And typically this involves the sale of things like stocks and bonds. So if you buy Microsoft at $20 and you sell it for $40 and you take a profit on $20 per share, then you have to pay taxes on that. But that's not considered income because you didn't work to earn it. You invested to earn it. And so that comes under a different tax code, and that's the capital gains tax. And so that's levied, the capital gains tax is levied on any gains that you have from those increases in assets that you sell. And this could be whether it's stocks or bonds or real estate or even heavy equipment, things like that. If you make money on the sales of those items, you should be paying capital gains tax. And their capital gains taxes are organized into short-term and long-term. Short-term capital gains are any gains that you earn by owning an asset for less than a year. So if you own, say, stock in Microsoft for 6 months, you buy it and then you sell it 6 months later, you would have to pay short-term capital gains. That's a short-term gain, and so you'd have to pay short-term capital gains taxes. Short-term gains are levied at the same rate that your income tax is. So if you're at the 28% income tax bracket, then they're going to charge you 28% for all of your short-term gains. However, if you hold those same assets for longer than a year and you sell them, so if you hold the Microsoft stock for a year and a half and then sell it, that's considered a long-term capital gain. And those are taxed at a flat rate of 15%. So, and that's how the tax code is written right now. So it's really advantageous for investors typically to hold their securities longer than a year because they're going to get taxed on it at a lower rate, assuming everything else is equal. If they can hold on to it and not lose, principal in their investment, then it makes sense to hold on to it for longer than a year, at least from a tax standpoint. They're going to be taxed less. So that's the difference between short-term and long-term capital gains taxes. And one of the reasons the tax code is built this way is because they want to try to encourage people not to be day traders, essentially. So that's the best example of a short-term trader, is a day trader, somebody who trades in and out of stocks constantly. That's not really helpful for companies to have their stocks churning away like that. It's really better for both the company and the market if investors buy something and then hold on to it for some period of time. It reduces
so many rules.
It reduces the amount of volatility in the stock price if people hold it for longer periods of time. And so that's why the capital gains tax is set up how it is. It tries to incentivize people to hold their securities for longer so they get taxed less.
So basically there's like 10 different forms for filing for your taxes.
Oh, there are hundreds of different forms. Yeah. No, the tax code is really complex, and the accounting and legal industry makes a lot of money off of that because people are forced to use, businesses and individuals in some cases are forced to use accountants and tax preparers because the code is so complex these days. And so even though a lot of people are advocating for simplifying the tax code, that puts a lot of these other interests at risk. Like accountants don't really want to see the tax code simplified because that's where they make a lot of their money from, interpreting complex tax code. And so
So like a business, do they have to do that each one individually? Like, do they have to fill out the form for the quarterly federal and for the employees withholding and for the, do they have to do each one separately when they fill out for the taxes?
Well, they have to fill out the corporate forms. I mean, whatever corporate forms they have to fill out, and they do have to document what they're paying employees and what they're withholding in taxes. Yeah, those are different forms, definitely.
Yeah.
Depending on the size of the business, they'll either have to fill out those forms monthly, quarterly, or annually. The smaller the business, the less frequently they need to file those tax forms. So.
Miscellaneous income, all that. That's a lot of fucking. Sorry, I didn't mean to say F word again. That's a lot of work.
Oh yeah, yep, it is. There's a lot of work that goes into having a company with public that sells public stock, because even more regulations are put in place at that point, just by the Securities and Exchange Commission. It's not even the IRS at that point. There are filing requirements that when you have public stock, you have to file these forms, and you have to do it, this frequently, and it's at least quarterly. In some companies, it's depending on the size, it can be even monthly. So
I feel sorry for the bookkeeper in that company.
well, that's how they make their money, though. All right, so the last tax I want to cover, and it's pretty similar to capital gains tax, is just a tax on dividends. So dividends are taxed differently than income, and they're taxed differently than capital gains. Again, a dividend is just a payment that a shareholder receives from a company based on the company's profitable operation. So again, if we look at this statement of cash flows here, this $57.5 million is the amount of money that the company paid out in cash to its shareholders. So every shareholder, I think, got $1.15 a share. And so that income that they receive from those dividends is taxed at a flat 15% rate currently. For dividends. So it's pretty similar to long-term capital gains in that it's going to be taxed at 15%, but they're taxed for different things. Capital gains, you're going to get taxed on a stock sale. If your stock price increases and you make money off of that, you'll be taxed on dividends if the company actually sends you a check based on the fact that you're holding one of their shares and they're paying out dividends, but they're taxed at the rate.
But if it's the stock, it has to be more than 90 days during the 181-day period that begins 90 days before the ex-dividend date, right?
Well, depending on the company, the shareholder has to have the share at a certain date to be eligible for the dividend, right? Okay. Yeah, and that can vary to some degree by company, but it's all stated up front. They tell you when you have to be holding the share in order to get the dividend when they're issued.
So let's say you received dividends on your credit card in your credit union. How would you report that income?
Oh, that they call interest dividends at your credit union. So that's really just interest income. You're getting paid 0.5% on your savings account or whatever that is. But yeah, that's really just interest income. So. All right, so that's what I want to cover about taxes from Chapter 3. Any questions about income, capital gains, or dividends taxes? Again, I want you to, I don't necessarily want you to be able to calculate taxes on income or dividends or capital gains, but I do want you to understand the concepts behind it and how they're taxed and how that works. So,
Steve.
Mm-hmm.
I had a question about like the stock market stuff. Because I have
Only if you're holding onto the stock and not selling it. I think the only reason you would, and I'm not a tax professional, so I'm not giving you tax advice right now, but I believe the only reason you would have to report that is if you were paid a dividend on any of those stocks. Then, if you were holding them and didn't sell them, so you had your share at the beginning, you had your share at the end of the year, but you were paid some dividends, then you have to report the dividend income. And in fact, the company has to report to the IRS all of the shareholders that it paid dividends to during the course of a year. So that's how the IRS checks to see if you've been reporting your dividends.
Yeah, I've always, well, that's why I picked those, because they do pay dividends.
Yeah.
So
yeah, yeah. So yeah, I would definitely look at what your requirements are for reporting that. I'm pretty sure you're supposed to report that each year. That's just one form of income, dividend.
okay.
Yep. So check on that.
So like as far as
Alright,
business goes, usually corporations will do it, right?
We'll do what?
As far as businesses, when income tax, when we talk about income tax and dividends and distributions of property and all that, if it's a corporation, then they will most likely pay it, right? They'll cover. I mean,
No, they won't.
They pay you
They will pay if the investors get a dividend. The corporation will not pay the income taxes on that dividend. The person.
I thought they pay most dividends in cash.
Right. And so if you receive that, then you need to pay that. Then that shareholder would need to pay the dividend income or the dividend tax on that income.
Yeah.
Yeah. So
and if it's a partnership thing, then you have to basically report your share.
Right. Yeah. And that's totally different because you're not getting dividends in that situation. But yeah, you basically need to report you're supposed to report any income you get through the year, whether it's through working, investing, or
paid out earnings, profits, even losses, all of it, right?
It should. Yeah. Yep. All right. Any other questions about any of that stuff? What are we doing here? No?
So you're going to take it easy with us with our homework from chapter 3, or like you've been doing, or are you going to make us do the whole chapter this time?
What? I missed your question. You were cutting out there.
I said, are you going to take it easy with us like you've been doing as far as our homeworks from the chapter?
Yeah, I don't know about take it easy, but yeah, your assignment is under week 4. And this, actually, I'll just say this about chapter 3 homework is you will want to, because each of these, how many problems did I give you here? 3, so there's only 4 problems, but these are difficult problems. And what I will suggest is that for each of them, if the question has to do with, let's say, an income statement or a cash flow statement, which I know a couple of these do, the best way to figure it out is to actually look in your book at an income statement, and based on the information they give you, complete your own income statement and then fill in the blanks for what they're going to be asking you. And that's the same for any of these, especially the one for the statement of cash flows. There's one of these questions has to do with the statement of cash flows, and really the only way you can figure it out is by taking the information, the numbers they give you, and inputting it into a cash flow statement of your own, just a real rough cash flow statement, and that's how you're going to get the answers. So that's what I recommend for all of the chapter 3 problems is that you just create a real simple draft financial statement to help you figure out what the missing piece is. Because the questions in Chapter 3 are all about finding the missing piece in the financial statement, essentially. So the easiest way to do that is just to create the financial statement and then look to see what you're missing. So, but yeah, I guarantee you, you will struggle with some of these from Chapter 3. They're not easy, especially the one with the statement of cash flows. So, okay. So for next week, what I would like you to do is, so I talked about the, let me get back to my Canvas page here.
So if we get lost or confused, can we call you personally for help if we need to?
Yeah, you can call or email me. I'm not always available via the phone, and most of the time you'll need to schedule time with me. So yeah, I would definitely do it sooner than later if you think you're going to need help. So under week 4, so for next week, those 3 problems 3.3, 3.4, 3.7, and 3.10. If you haven't registered for NNI, which I hope all of you did tonight, if assuming you hadn't registered before, do that for next week. And then we're moving on to Chapter 4. Will be the next chapter, and that's the chapter that will start really calculating some performance metrics for companies based on these financial statements that we reviewed this week. So
Moving right along.
yeah.
Registration for NNI, will you have to submit anything, or will you know?
No, I will know. Yeah, so I'm going to email that organization tomorrow, give them all your names, and they're going to let me know if you've registered or if you haven't. And if you have registered, they're going to move you up to the nation-owned enterprise module, which is where everybody should be. And so if for some reason there's a registration issue, I'll email you or to get it figured out. But yeah, my goal is by next Tuesday, everybody should be able to get to page 1 of the nation-owned enterprise module, and then we'll start working on that. Okay. The last 2 things, I'm actually moving these right now. 2 readings for next week, because I'd really like to discuss this. It's sort of current news. Though I just put 2 readings under the assignment section of week 4. Wells Fargo executives forfeit millions and CEO to forego salary amid inquiry. Yeah. Yeah, so that's a really good article, informative about something that's going on right now with Wells Fargo. They're getting in big trouble. They're about to get in big trouble.
Yeah.
And then the one right below it, I thought was a really great article on these 2 academics who did a bunch of research on how contracts work, and specifically how contracts with executives work for-profit companies. And so I'd like you to read both of those for next week, and then we're just going to sort of talk about it because it gets into discussions about what sort of incentives are beneficial to provide CEOs and maybe what incentives don't work so well. Because incentives in the past have caused or have promoted behavior by certain executives that was contrary to the benefits of the company. So basically they were doing things on their own and not really concerned about the long-term well-being of the company. So we'll get into some of those issues, talk about some of those issues next week. So read those 2 and then you'll be good to go for that discussion. All right. Yeah. Yeah, and if you haven't read Chapter 3, read Chapter 3. But Chapter 4 for next week. So any other questions before we call her a night? No?
Are you going
All
to
right.
the study center at all?
Study center? No.
Athletic center? No, you never in there?
I'm never in this. No.
Do you have open office hours so I can drop in?
No, you got to schedule. I don't have regular office hours, so you got to schedule time with me because I got this full-time gig I'm doing during the day.
So the best time to schedule is online, you say?
Yeah, I mean, if you email me or with a couple times that you'd be available, then I can get back to you and we can schedule a specific time to, yeah. Usually it's helpful to do like a Zoom session if you're not here on Lummi campus to show some of these, so we can
Right.
set up a time to do that. Yeah.
Hopefully you have some time. I think I'll be scheduling.
I will have time. We'll just have to make time, yeah.
Okay.
Night.
Good night.
All right. Have a good week. See you all next week.